Welcome to the Marxist Workers Party's podcast, Izwi Labasebenzi, bringing reports and analysis of the news from a working class and Marxist perspective, fighting for jobs for all, a 12,500 Rand per month minimum wage and high-quality service delivery, organising to arm the workers and trade union movement with a revolutionary socialist and Marxist programme, building the struggle against capitalism and for working class political power and socialism.
The date is the 6th of September 2021. In this bulletin, we analyse South Africa's capitalist economy and ask, what prospects, if any, are there for a post-COVID recovery? Mining profits are booming. June saw the biggest trade surplus on record. The banks are paying dividends to shareholders again, and Stats SA reports that the economy is 11% larger than thought. But unemployment has reached yet another record high. Incomes are falling and poverty is increasing. As the ruling class desperately looks for signs of a post-COVID recovery, the inequalities and contradictions of South Africa's capitalist economy remain as deep as ever. The few green shoots the bosses point to are utterly dependent on the current conjuncture in the world economy and in fact underline the sickness of South Africa's capitalism. There has been some recovery in the world economy, even though many countries have not yet reached their pre-pandemic levels of output, employment, or living standards. A certain recovery was inevitable after the devastating slumps in 2020 under the impact of the COVID-19 pandemic and rolling lockdowns. But uncertainty, instability, and dangers are present everywhere. Two features of the world economic situation are particularly significant for perspectives for the South African economy. Rising commodity prices, boosting South Africa's mining sector in particular, and the unprecedented stimulus packages, especially that of the United States, are allowing South Africa's capitalism the appearance of defying gravity. But the fall to earth will come.
The US stimulus program has been crucial in postponing South Africa's looming sovereign debt crisis. On 27 March 2020, the day that South Africa entered its first hard lockdown, the ANC government lost its final investment grade rating. All the major rating agency companies now rate South African sovereign debt as junk. This caused a sell-off and an almost 30% surge in debt servicing costs on South Africa's crucial 10-year bond. However, the near-simultaneous introduction of the US stimulus program ensured there were enough dollars in the world chasing higher returns that still saw South African debt as a good investment. In the last 9 months of 2020, 5.4 trillion rands has flowed into emerging markets. Exactly how much of this hot money is invested in South African sovereign debt is largely locked away behind the capitalist class's wall of business secrets. However, the South African Reserve Bank data suggests that it could be hundreds of billions of rands. Indeed, the South African Reserve Bank flags the significant increase of bond purchases by non-residents as behind a significant increase in South Africa's total external debt in the second half of 2020. In the short term, however, these inflows helped return South Africa's debt servicing costs to normal. Completing this, The commodities boom has further eased pressure on government finances with a series of tax windfalls, especially from the major mining companies and other exporters. Stats SA's rebasing of the economy's GDP has also eased pressure in the short term. The debt to GDP ratio and the size of the government's budget deficit have been revised down from 80 to 71% and 14 to 12.4% respectively. They are the key debt measures watched by the rating agency companies. Capitulation by the majority of public sector trade union leaders signing a rotten pay deal with the ANC government has also helped reduce public spending. However, all of this taken together has only given the ruling class a little breathing space. The direction of travel towards unsustainable debt levels and a possible sovereign debt crisis has not changed.
Growing financial volatility around the US's Jackson Hole meeting on 27th August showcased South Africa's vulnerability. This annual symposium is used by US bankers and officials to prepare the capitalist class for possible future policy changes. With inflation, i.e. price rises in the US at its highest in more than a decade, there had been speculation they would start to taper or reduce their stimulus. Following the 2008 world economic crisis, the US also embarked on a massive stimulus program. Scaling this back from 2013 triggered a so-called taper tantrum across emerging markets, leading to massive capital outflows which destabilized the huge financial markets and many economies. South Africa was one of the so-called Fragile Five most affected. The speculation in the run-up to Jackson Hole was sufficient to produce a micro taper tantrum. In the weeks before, the rand dropped to a 6-month low. In the event, the chair of the Federal Reserve, Jeremy Powell, indicated his preference to wait and see. A taper would only be considered at the end of the year. In response, stock markets around the world surged. In South Africa, the rand and the JSE shot up and government bond yields fell. The South African ruling class's utter dependency on developments in the world economy was graphically demonstrated. Today, South Africa is even more fragile than it was in 2013. Since then, the debt to GDP level has almost doubled. Debt service costs are now the fastest growing item of government spending. They already consume 13% of the national budget. Any taper tantrum in these circumstances will be disastrous. The development of the postponed sovereign debt crisis would be posed, but forced to fall back on its own resources, the South African ruling class would have to admit what it already knows. The cupboard is bare.
The COVID-19 pandemic and lockdowns have battered the South African economy. In 2020, it shrank by 6.4%. This is the steepest decline since at least World War II and possibly in 100 years. The effect on the working class, the middle class, and small, informal, and even medium businesses has been a disaster. Unemployment continues to climb. It reached a record high of more than 44% and over 64% among 15 to 24-year-olds at the end of June. The return to profitability in some sections of the economy is not translating into job creation. Standard Bank highlights the contradiction. They have retrenched 1,000 workers but plan to pay out 5.72 billion rands in profits to shareholders. The middle class has suffered a massive loss of income. There has been a 17% drop in the number of individuals earning between 22 and 40,000 rands per month and a 23% drop in those earning over 40,000 rands per month. Up to the third quarter of last year, 290,000 small, medium, and micro or informal businesses closed, destroying 1.5 million jobs. The third wave lockdown has permanently closed another 1,100 restaurants, and liquidations and insolvencies continue at a high rate. The long-term damage from July's riots and looting, estimated at 50 billion rands, will be its consequence for jobs and small businesses destroyed. However, the combined effect of the commodities boom and the US stimulus program in holding up the rand has allowed the South African Reserve Bank the space to lower interest rates to historically low levels and hold them there. This has eased some of the pressure on the working class, middle class, and small businesses by reducing the cost of loan repayments, home bonds, etc. However, interest rates will quickly rise when the US's taper eventually begins, squeezing living standards even higher. The desperate situation faced by huge swaths of the South African population also tells the other side of the trade surplus story. The weakness of domestic demand contributing to low levels of imports. South Africa's real trade position is a disaster. The growth rate of exports has actually halved over the last decade, and South Africa's share of world trade fallen from 0.6% to 0.4%. Worse still, from the point of view of the health of the economy, the weight of primary exports such as commodities, in other words, mining output and agriculture, whose prices are determined by the world market and denominated in dollars, has increased, further reinforcing the ruling class's dependence on the world economy. Despite some increase in mining production, the soaring commodity prices are not matched by corresponding increases in output. Quite the opposite. Investment in mining exploration has sunk to a 20-year low. On the African continent, South Africa's exploration investment has fallen behind the DRC, Ivory Coast, Ghana, and even Burkina Faso and Mali. The commodities boom is simply papering over the continuing decline of the sector. Behind the headline of State SA's rebasing is more bad news. The growth is almost entirely accounted for by larger than previously thought finance, real estate, and business services industry and household consumption. Despite some belated recovery in the last month, manufacturing has suffered a steep decline. It has still not recovered to pre-pandemic levels, which before the March 2020 lockdown has seen 10 consecutive months of contraction. Gross fixed investment spending, a key measure of investment in machinery, is at its lowest levels in 40 years, just 13.7% of GDP.
The reinstatement of the 350 social relief of distress social grant in the wake of the riots, debates about the introduction of a permanent basic income grant, BIG, a national social security fund, now U-turned, and the changing of pension rules to allow larger early withdrawals all reflect an awareness within the ruling class that the social explosion seen in July can be repeated and on a larger scale. However, the political crisis within the ruling class, which we will return to in the next article in the series, reduces every possible reform into a war of factional position. While we would support, for example, a BEG, All such measures, even if the ruling class was capable of implementing them, are ultimately only sticking plasters on a gaping and festering social wound. The South African ruling class has no solution to the contradictions of their system. There is nothing in the Economic Reconstruction and Recovery Plan or Operation Vulindlela that can fundamentally alter the trajectory of South African capitalism. Nevertheless, we will return to analyze these policies in future material. Fearing inflation and the destabilizing effects of massive financial speculation, the US will, sooner or later, try to taper its economic stimulus. This will mean that capitalism boom-slump cycle will come out into the open once more. The commodities boom will end. Already before the pandemic struck, the world economy was slowing down. Now we face a far more unstable situation. In a weaker economy like South Africa's, the waves of economic crises will wash ashore sooner rather than later. The ruling class will be compelled to increase its attacks on the living standards of the working and middle classes. The looming sovereign debt crisis, which will plunge the entire economy into an even deeper crisis, is not likely to play out as a single once-off crash, but more likely a series of deepening crises over a whole period.
At each stage in the looming economic crisis, the classes will be brought into sharper and sharper collision. The working class needs to be prepared for what is on the horizon. Between 2005 and 2021, the ANC government transferred 1.8 trillion rands to the capitalist class in sovereign debt interest payment. This could have paid off nearly half of government's 4 trillion rand debt, but it did not touch a cent of that principle. A socialist program would be clear that these capitalist vultures will not get any more money at the expense of the masses' living standards. The domestic banks, to whom a large portion of sovereign debt is owed, will need to be nationalized along the monopolies and biggest companies in all the key sectors of the economy, including agriculture, mining, construction, transport, manufacturing, telecommunication, wholesale, retail, and distribution. Nationalization on a socialist basis would have nothing in common with the ANC government's run-down state-owned enterprises, bled dry through corrupt tenders and cadre deployment. They would be under democratic control, with representatives of workers and communities sitting on elected and accountable boards. In the event of a sovereign debt crisis, capital controls, price controls, and controls on exports and imports will need to be implemented to defend the ravages of the capitalist machonistas. These policies must also be under the democratic control of workers and communities. Together, this will lay the foundation of a democratically planned socialist economy in which the country's resources and the talents of its people could be used for the benefit of the working class and poor, not the capitalist class and their hangers-on. But this will remain a paper program without a vehicle for its implementation. Neither the ANC government nor any combination of the political parties represented in parliament would ever contemplate such a socialist measure. The creation of a mass workers' party is urgent. In the stormy events that lie ahead, with a socialist program and a correct approach, a party with even a small beginning can be propelled forward rapidly by the masses, posing the creation of a workers' government.
If you have any questions or comments about the contents of this bulletin, please let us know, and we may try and respond in future bulletins. Also, if you know about or are involved in any struggles you would like us to report on, whether that is in your workplace, your community, your university, college or school, or have any suggestions of future topics that you would like us to cover, please contact us. The Marxist Workers Party is an affiliate of the Committee for a Workers' International, the CWI, building global working class unity in the struggle for a socialist South Africa, a socialist Africa, and a socialist world. If you would like to join the Marxist Workers' Party or find out more about us, including building the CWI in Southern Africa, please visit our website at www.marxistworkersparty.org.za, find us on Facebook and Twitter, or call or WhatsApp us on 081 366 7375.